Welcome back to Investing Talk Podcast.
Today we're looking at Apple. The big question is it a good time to buy now?
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. You gave us a stack of sources, and they really paint a picture of a company, well, firing on all cylinders.
Yeah, but trading near record highs, right? That's the tension here.
Exactly. We have to set the scene properly. Apple's recent performance, it's been exceptionally strong, and honestly, that strength is what's justifying, or trying to justify, its current valuation up near $270.
And those Q4 2025 numbers, the September quarter ones, they were pretty striking when I looked through the sources. Revenue up 8% year over year, which is solid.
$102.5 billion quarterly, not small.
Not at all. But what really jumped out at me was the efficiency. That diluted EPS, the adjusted number, it jumped, what, 13%?
13%.
Yeah.
To $1.85. And that handily beat the consensus estimates. It's a pretty significant beat.
That kind of jump, that difference in earnings per share growth versus revenue growth,
Yeah.
that tells a story, doesn't it?
It absolutely does. That's the real sign of operational health. And the why behind it, that's what we need to break down for you listening. It seems to be twofold.
Okay.
One, you've got robust early sales of the iPhone 17. Looks like that post-pandemic upgrade cycle, it's still got some legs, providing a nice tailwind.
People are still upgrading that.
Seems like it. And critically, number two, the high-margin services segment. That continues to just power ahead.
Services. Okay, let's talk about that because you hear that constantly. It's the key to Apple's stability, its future.
It really is central to the thesis now. So services revenue, all-time high, $28.75 billion in just that quarter.
Wow.
Now think about that. That's 28% of their total sales. This diversification, it's the company's real financial muscle these days because services money isn't the same as hardware money.
How is it different, though? I mean, $28 billion is just $28 billion, right?
Yeah.
So then if it's an iPhone sale or like an App Store cut.
Oh, it matters a lot. Think about services, App Store, Apple Music, iCloud, all that stuff. It's not something they build fresh in a factory each time. It's more like a high-margin toll booth.
Toll booth.
Yeah, sitting on top of their, what is it now, over 2 billion active installed devices around the world. That cash flow is predictable, it's sticky, people don't leave easily, and crucially, it costs almost nothing extra to deliver to one more user. Very little incremental cost.
Okay, that makes sense. It's almost pure profit compared to building a physical phone.
Exactly. And looking at the full fiscal year reinforces this. The sources highlighted this operational mastery. Full year revenue grew, what, 6.43%? Decent.
Decent top-line growth.
But because of that services leverage and just tight cost control everywhere else, their net income, the bottom line profit, it's surged almost 19.5%.
19.5%.
To $112 billion.
$112 billion in net income. That huge gap, 19.5% profit growth on 6% sales growth, that's textbook operational leverage right there.
So they're squeezing more profit out of every dollar of sales. Precisely. It proves they've really optimized their whole operation, their supply chain, everything. And more importantly, they are successfully harvesting value from that enormous installed base we mentioned.
And that base keeps people locked in, the customer stickiness.
That's the ecosystem lock-in, yeah. And it underpins their net profit margin, which is around 26.9%. Just think about that number.
27% net margin.
Yeah, roughly, which is substantially above the average for the tech sector. It's quite remarkable.
Okay. Fundamentals look basically flawless. Strong growth, incredible margins, sticky customers. But the price. We have to talk price.
You do.
Stock's riding high, near those record levels, $269, $270 a share. And that 52-week range you mentioned in the notes, it expanded like 64% from its low of $169.
Huge run-up.
Doesn't that kind of momentum usually mean, it's gone too far, the easy money's been made?
Well, it's a valid concern. The technical picture definitely suggests sustained buying, bullish accumulation, as they call it. But yeah, the valuation conversation is unavoidable at these levels.
So the trailing PE, based on past earnings, is 36.07. That sounds pretty expensive compared to the broader market, right?
It is objectively high, yes. For anyone listening, a 36 multiple means you're paying $36 for every $1 of Apple's earnings over the last year. That's steep.
But the forward PE, the one based on expected future earnings, that drops down to 32.76. What's that compression telling us?
It tells us the market is betting, and betting pretty heavily, that the company's projected earnings growth, that huge 19.5% surge we just talked about, is going to catch up to the current stock price really quickly.
So the market sees the growth coming. It's pricing in near perfection already.
Essentially, yes. Because of that expected fundamental strength and, importantly, the catalysts coming up soon, the market is anticipating continued strong performance.
And the technical outlook, the chart pattern itself,
Yeah.
seems to back that expectation up.
For the near term, yes. The technical view for the next, say, 3 months looks pretty constructive. Analysts are seeing a trading range maybe anchored near $260 on the low end, the support level, with maybe an upper ceiling around $285. And the analyst consensus target price, short term, is right around where it is now, $270.63. So it suggests the immediate momentum could still be positive, or at least stable.
Okay, let's unpack that, though. If the stock's already trading high near that consensus target, what could actually push it higher? Into that, say, $280, maybe $290 range you mentioned. We need specific events, right? Tangible catalysts in the next 90 days.
Absolutely. And the next quarter is actually pretty dense with potential catalysts. There are really 3 key windows to watch, starting almost immediately.
What's first?
First up is the holiday sales data. We should get initial reads right after Black Friday and Cyber Monday, so around November 29th. Expectations are, frankly, sky high.
For the iPhone 17 mainly.
For the iPhone 17 series volume, yes, but also for the performance of those new M5-powered devices, the iPad Pro, the MacBook Pro. Those are important because they tie into the bigger strategy shift.
Right, the M5 chips. And those tie directly into the really big buzzword right now, Apple Intelligence.
Exactly. That's the longer game. But sticking to the next 90 days, before we get deep into AI, let's look at the money flows.
Okay.
The second key window involves financial reporting and positioning. December 16th, you've got major ETF rebalancing. That can shift demand. Then January 14th is the deadline for the big 13F filings.
Ah, where the big funds reveal their hands.
Precisely. These filings show us what the huge managers, the BlackRocks, the Vanguards are actually buying and holding. And the sources suggest there's growing institutional appetite for Apple, seeing it as sort of a defensive growth name. Safe, but still growing, you know?
The safe growth stock.
Yeah.
Interesting positioning in this market.
It is. And then the third, and probably the most critical near-term event, is the Q1 FY 2026 earnings release. That'll be late January 2026.
That's the big one. Covers the whole holiday quarter.
It's the moment of truth for this recent run-up. Analysts will be laser-focused, not just on the headline numbers, but really on the forward guidance. Are services still accelerating? Is the demand for new hardware holding up? That report will be key.
Okay, so holiday sales, fund flows, and Q1 earnings. Got it. But let's circle back to that AI piece, the Apple Intelligence, because that feels like the really interesting longer-term story here. Analysts are calling Apple an eventual winner in AI. That's a bold claim given how big they already are.
It is bold, but there's a logic to it, their potential winning strategy. It lies in controlling both the hardware and the software. That's something their major competitors like Google or Microsoft to some extent don't fully have in the consumer space.
And the M5 chip is central to that.
Absolutely. The M5-powered hardware they just unveiled, that reinforces this strategy. They're putting incredibly powerful custom-designed silicon right into users' hands, and this custom chip design allows them to do something really important.
Which is?
Run sophisticated AI models locally on the device itself, instead of relying solely on the cloud.
Okay, why does running AI locally matter so much?
2 huge potential advantages. Speed and privacy. If the AI processing happens right there on your phone or Mac, you don't need to send your data out, wait for a server, and get it back.
So things feel instant, like Siri actually working well for once.
That's the hope, yes.
Yeah.
Instantaneous experience is crucial, and maybe even more importantly in today's world, it plays directly into Apple's long-standing narrative around user privacy.
Right, that's a huge selling point for them.
It's a massive competitive differentiator, potentially a moat against companies whose business models rely heavily on cloud data processing. So yeah, we're expecting major upgrades maybe to Siri, maybe the whole home ecosystem likely coming next spring, all powered by this on-device AI running on custom silicon.
Gotcha. So the M5 isn't just a faster chip, it's basically the engine for their future AI services, which could be high margin too.
Yeah.
Are there other sort of futuristic things baked into this high valuation optionality, they call it?
Definitely. You have to factor in the long-term optionality. Those persistent Vision Pro 2 rumors for late this year, early next year, that's their big push into spatial computing. Still early days, but potentially huge.
In foldables. Everyone talks about a foldable iPhone.
Yep. Ongoing speculation there. A new form factor could definitely refresh the iPhone line dramatically down the road. And the sources even mention preliminary steps into consumer robotics. very long-term, but it shows they're thinking beyond current categories. These are all potential growth levers that go way beyond just selling the next iPhone model. But okay, we've painted a pretty rosy picture here, focusing on the strengths and the potential upside. To provide a balanced view, we absolutely need to talk about the counterbalance, the risks.
Right. You can't look at any investment without understanding what could go wrong.
Exactly. This analysis is incomplete without acknowledging the key risks that could derail this seemingly perfect narrative.
Operationally, the big one still seems to be iPhone concentration.
Right.
Even with services booming, the sources are clear. The iPhone is still a huge chunk of revenue.
It is. And while demand looks strong now, there's always the risk of softness. Maybe upgrade cycles stretch out even longer than expected. Maybe competition gets tougher. That concentration risk hasn't disappeared.
And tied to that is China. That dependency feels like a bigger risk than ever.
It's definitely a magnified headwind right now, yeah. A huge portion of their revenue comes from Greater China. And you have geopolitical tensions simmering, plus really fierce local competition surging back. Huawei, Xiaomi.
They're making good phones again.
They are. And that combination could really challenge Apple's ability to grow or even maintain market share there. Any negative headline out of China, political or competitive, can hit the stock price hard and fast. Volatility trigger.
Okay, so iPhone concentration, China market. What about external risks? Regulation seems like a big one, especially for services.
That's the big shadow hanging over their crown jewel, the services segment. You've got ongoing antitrust scrutiny heating up in both the EU and the US, and it poses a direct threat to their highest margin business model.
Specifically the App Store commissions, right?
Yeah.
The Apple tag.
That's the main target, yeah. If regulators force significant changes how they handle third-party payments, the commission rates they charge developers that could directly eat into the margins of that critical 28% of the business we were just praising.
So even if the business is firing on all cylinders, a regulatory headline could knock the stock down.
Absolutely. It could trigger sharp swings, regardless of how strong their quarterly results actually are. Creates uncertainty.
And the last risk, maybe the most obvious one given this discussion, valuation risk itself.
Yep. We talked about the high multiples, 36 trailing, almost 33 forward. If those high growth expectations aren't met, maybe that 19.5% net income surge slows down faster than expected.
Or just a general market shift, people rotating out of expensive tech.
Exactly. If there's a broad tech sector rotation away from high multiple growth stocks, Apple could get caught in that downdraft. It could trigger a swift downward re-rating simply because so much good news, so much future growth is already baked into the current price.
It's that risk of pricing imperfection, if you stumble even slightly.
The downside can be dramatic, yeah. Simply because the starting valuation is already elevated.
Okay, so we've got this picture. Overwhelming financial momentum, huge profit margins, the AI potential, but also real risks like iPhone dependency, China, regulation, and that high valuation. Pulling it all together, what does it mean for you listening? The analyst consensus is still a buy, right? An 8 out of 10 bullish rating.
It is, yeah.
Why does that strong conviction hold up, despite these clear risks we just laid out?
I think it boils down to the core investment thesis changing or maybe solidifying. The market isn't just buying a phone company anymore. It feels like it's buying a platform that controls the entire consumer experience, from designing its own custom silicon all the way up to delivering cloud services.
That's the whole package.
It's a whole integrated package. So the combination of that really strong fundamental momentum we saw, the technical picture, which looks constructive, and critically, that high density of near-term catalysts packed into the next quarter, it just seems to create a compelling risk-reward setup for many investors, despite the risks.
So if I'm listening right now, maybe holding the stock or thinking about buying, how should I think about timing an entry or managing a position? What's the horizon look like based on the sources?
Well, for, let's say, short-term tactical accumulation, maybe playing these next 3 months, it looks pretty favorable based on the setup. If you're targeting that $280 to $290 range we mentioned, you're essentially betting that the holiday sales data and, more importantly, that January earnings report will deliver on those high expectations and provide the next leg up. It's an event-driven trade, almost.
Okay. And for the long-term investor, someone just looking to build wealth over years?
For the long-term strategic holder, Apple seems positioned for, sustained wealth creation, primarily because of those really durable competitive advantages we discussed.
The ecosystem, the services.
The ecosystem integration, yeah. The recurring revenue from services, which is growing, and now this leadership position they're carving out in custom silicon specifically for AI. That's powerful. So for the long-term holder, any significant pullback?
Like if regulatory noise hits the stock or the market dips.
Exactly. Those kinds of pullbacks should probably be viewed as potential accumulation opportunities rather than reasons to panic sell. It's really become a foundational tech holding for many portfolios. I think the critical takeaway, maybe the final thought for you to consider, is this. Apple's story, its destiny, it's not just about how many iPhones they sell next quarter anymore. That's still important, obviously.
But it's shifting.
It's shifting. The real focus now is on how effectively they can extract that high margin value from the 2 billion active users they already have locked into their ecosystem. And increasingly, how quickly they can integrate and then monetize this custom silicon advantage for the next wave of AI applications. That fundamental shift, that's what potentially justifies a near $4 trillion valuation, making it much more than just a hardware company.